And so then we have down here on the expense side of things. So I'm going to collapse all of the little triangles under the expenses. So then we have the expenses. Now the expenses are the things that we consumed in order to generate revenue. Noting that when cash goes out of the business, or when you buy something, which typically means cash is going out of the business, the other side is usually an expense. And therefore the expense forms are the thing that we can generate most readily oftentimes with the bank feeds. Because every time we pay for something, we can determine by who the vendor is that what we paid for, which is usually like the telephone bill, the utility bill, and so on and so forth. And we can assign those to an expense as we pay for them. So that's the main thing you're often going to do when you set up a new company file and you're excited about possibly setting up the bank feeds. The bank feeds are going to track all of the outflows, noting that when you think about the checking account, which is the lifeblood of the company, there's going to be a higher number of transactions that have outflows than inflows. However, we're hoping that the inflows, revenue that comes from the revenue cycle, is greater in dollar amount than the outflows that are happening, right? So that's why on the expense side of things, you're going to have a whole lot more categories. The other way you can think about it on the income statement, this is usually where you have the most detail. Why? Because on the income side of things, we only do one thing. We might just sell one thing. But we're hoping we generate a lot of revenue from selling that one thing. We are specializing in the one thing. Everything else we're not specializing in, we are paying for, and therefore there's going to be a category for everything we need in order to support that one thing that we're doing to generate revenue. So that's why there's going to be all these different categories on the expense side of things. You have a similar kind of thing to be careful of with the expense side of things, that being you don't want to set up your expense accounts by who you paid. So you don't want to set up an expense account that says Verizon expense or AT&T expense or Edison expense. Those are the vendors. Those are the people that you paid. What you want to do instead is translate, usually through the bank feeds, by vendor what you paid for, and then put the expense account based on that, which will be telephone expense, utility expense, and so on and so forth. Now, note that the expense side of things also usually has the biggest range of how you want to set it up. Meaning, some accounts you can think of as basically standardized between businesses, like the telephone it is what it is. The telephone, the utility is usually the same. But your business might have expenses that you pay for that are different than other businesses because of the industry you're in. Like famously from a tax perspective, if you're like in an industry that somewhat sounds fun to an IRS auditor, then they're going to be more skeptical about those industries, right? So like if you're a filmmaker and you're researching by going to the movies, maybe that would be a legitimate expense for the movie ticket. But if I was an IRS auditor, I'd possibly be like, well, that doesn't sound right. You know, you're expensing a movie ticket. What? Or if you're a photographer and you went to Hawaii or something like that, and you're kicking it on a paddleboard, you know, filming things and then calling it an expense. Again, possibly that's legit if you are a photographer, but from the standpoint of an IRS auditor that's supposed to be sitting in the IRS office, they're not really these days because the government got crazy. So a lot of the government are sitting at home doing nothing. So they're probably in Hawaii too, just doing nothing. But they're cracking down on it now. So they're cracking down on the government workers. And if they actually had to do work, then they would be like in the office doing work, and they would be jealous of someone who has a job of taking pictures, right? So you get the idea. So you might have different expense accounts. So you want to set those up basically as you go. All right. So then on the expense accounts, if I go into one of these, for example, then you can see that they're being created either with a bill form or a check form or an expense form. The check form and expense forms are the forms that decrease the checking account. The bill form is the form that you would use if you're entering the bill but not yet paying for it. It's an accrual form, the one that's going to increase the account's payable account that you will then have to pay off at a later time. All right, so the expenses that we have here, notice we have the collapsible expense column, And then we also have in there these other collapsible areas. Where do these come from? These are what we call sub-accounts. So you're probably going to have more capacity for sub-accounts in here than any other location on the financial statements. The sub-accounts is going to be QuickBooks' major way of being able to customize the financial statements. Now note that you could order your expense accounts by, say, by account number. You can add account numbers. But a lot of people don't like doing that because they're not really good at organizing the account numbers. So they just don't do account numbers, which is the default setting within QuickBooks, which is fine. But then within each category, the expense category being the longest, it's going to organize your accounts in alphabetical order, which might not be the way you would ideally want it. So then the next thing is, well, how can I organize my accounts in more of an order that I want to without account numbers? One way is with the use of the sub accounts. So for example, if you have the automobile, you might have multiple things that you pay for the automobile, like new tires or just maintenance, fuel, insurance. You might put all of those things into one account called automobile expenses. However, it might be useful. You might like to break them out so you can break out the detail of the fuel versus so on and so forth, right? So how can you do that? You can make a parent account called automobile, which oftentimes you wouldn't post anything to, and then add all the sub accounts that you're going to be posting to. Notice what that does. It adds a lot more line items on the financial statement because one, you're adding more accounts instead of just using one account. So the question is it worthwhile for me to have 3 accounts for automobile, fuel, maintenance, insurance, for example, versus one account, which would be, easier in some ways, although less detail. And then if I put them into a sub account, I add 2 more columns, right? Or rows. I have a row here or here, and I have a total here. So these sub-accounts allow I could collapse the sub-accounts and then give a financial statement that has the collapsed sub-accounts and then expand them and give them more detail. That's the cool thing about sub-accounts. And you have a collapse function up top. So I can collapse them. That cleans up the financials, possibly for external reporting or less detailed reports. And then I can expand them, giving me more detail in those. But it also adds a lot more information. So some people go way too far with too many accounts because they like the detail. Other people go way too far in too few accounts because they don't like the detail, right? So that's where the play is on the income statement. And then at the bottom of the income statement, we have the other expenses. Down here, you could have other income and other expenses because you might have things that aren't part of your normal operations. So you might have, for example, interest is one thing that sometimes is put down here. Miscellaneous, I don't think is actually proper down here, but you can like miscellaneous, like interest. Interest expense is only there because you had a loan taken out. So maybe it would be appropriate to put that interest expense in the body up here as a normal business expense, but it's not really part of the business. It's part of financing the business. So you could make an argument that you should put the expense down here possibly. Or if you sell stocks and bonds and you had a gain on the stock and bond sale, but your business is not in the business of selling, it's not a financial business, you just happen to have some stocks and bonds, then that's not an expense that you expect to have happen all the time, and therefore you might put it down here. That could be useful because what you want to get is to the net operating income from operations, because that's your operating income, and the things that you don't expect to be repeating, that's when you would have it down here, like a gain on a sale of stocks. If I don't sell stocks all the time, I'm going to put it down here and say, yeah, I had this gain, but it's not going to happen next year because that's not my normal business. This is the performance that I expect to be repetitory, or the thing that I want to compare performance-wise from period to period. Now, we also could have the same thing on the income side of things down here, and then you get to net income down below. I also noticed that we had the cost of goods sold in here somewhere. This was income, total income, they don't have the cost of goods sold. Let me go back. Let me go to 2025. 01/01/25, 12/31/25. Is there any cost of goods sold? There it is. So here's cost of goods sold. Cost of goods sold represents inventory that we're selling. And you would only have cost of goods sold if you sell inventory. So we'll get into that more as we go. So let me just kind of give a summary of this. If I was to collapse the major categories, if all I had was income and expenses, we could call that a single step income statement. Sometimes they call it that in textbooks. That's the easiest income statement. Or I could add more subtotals like cost of goods sold. Cost of goods sold is an expense, but it's often the most important expense if I sell inventory. If I sell inventory, the cost of the inventory is usually the biggest expense. Therefore, I'm going to break out a special subcategorization just related to the cost of goods sold. So it's just kind of like a pit stop along the road to the bottom line of net income. So in this case, it's at the 3959.8 minus the 405. That gets us to the 3554.80. And then all of the other expenses, the normal category minus 1780.8, that's going to give us our 1774. And then if there was any other income and expenses, I would add them as another subcategory to get us down to the net income. So notice that if we have any of these subcategories, these subcalculations, it's always going the same way. The income is what we generated. Everything underneath it are the things that we consumed in order to generate the income. Therefore, they're going to decrease the income. One more thing to point out on these expenses. Notice that usually if cash goes out of the business, it's because you're paying for something in order to help you generate revenue in the current time period. But sometimes you're paying for something that's going to help you generate revenue into the future. And that means that's why you'd put it on the books as an asset as opposed to an expense from an accrual standpoint, noting you can't get away from accrualness sometimes, meaning if you paid $100,000 for a building, even if you're on a cash-based system, you're going to have to do the accrual thing, putting it on the books as an asset, at least if you're in the United States, because the IRS is going to force you to do that. If you didn't do that, what would happen? You'd have this giant expense on the books for a building that you're going to be using for 30 years. So see how that doesn't make sense from an accrual, from a comparative standpoint. If I had like January, the month of January, I had a $100,000 expense for this building that I bought. And then in February, I'm not going to include the building expense. It's going to look like I had a horrible month in January compared to February because I'm going to have this huge loss in January and not in February. But I used the building in February, even though I bought it in January. It's just that, I paid for it in January. And that's what the accrual thing is doing. So anytime you have a larger expense that you're purchasing, we have to think about, should I record it to an expense account or does it need to go on the books as an asset, typically under property, plant, and equipment? All right, so that's the general idea with the income statement, the performance statement, the profit and loss, sometimes called the P&L.